Ladies and gentlemen, down Friday, down Monday, it seems to be the trend. Markets are down today, at least at the time of recording this video. The S&P is down 0.61%. At one point today, the S&P was down almost 2%. It was a lot worse. You have bounced back a bit from the low of the day today, which was 584.41 on the SPY. Currently, you're at 591.37 on the SPY. And you know the craziest thing about all of this? As you can see here from CNBC, it says, quote, "There was no apparent news catalyst for Monday's decline, and trading was expected to be light given the shortened week." The SPY had about 23 million shares in total volume shortly after noon, an abnormally low amount for a day with a significant market decline. So what's going on? As I explained in the last video, today and tomorrow are the last days of 2024. That means, tactically speaking, there is a lot of tax loss harvesting. There is a lot of last-minute positioning, and some would say profit taking. Now, when there is low volume and there is this weight towards reducing exposure, reducing positions, selling, it's not a lot to help offset that, right? There's just low volume. People are not really in the office. They're not really, doing too much trading. So some of these tactical repositionings, I will call them, can influence the markets a lot more than otherwise they would, okay, during like a normal trading day. Now, we did have some bad news today, but it's not the reason why markets are selling off. We had Chicago PMIs that came in at 36.9. The expectation was around 43. And it says here, the latest data indicated that Chicago's economic activity contracted for the 13th consecutive month. So it's been bad for a while. Just this was the steepest decline since May of 2024. New orders fell 13.5 points to the second lowest since May of 2020, with more than half of respondents reporting fewer new orders for the first time since June of 2020. So there was definitely some weakness in the data today. But, it's kind of one of those weird things that doesn't make a whole lot of sense with the prevailing narrative on markets that people have had. Okay, because a lot of people said 10-year treasury yields were the reason why stocks were declining. Well, they're retreating today, down 6 basis points. But that's not really helping markets today. So I think you can kind of throw the argument of 10-year treasury yields rising as the big bear catalyst out the window. Now, before we go any further, and before I explain just how negative markets are and why you want to be buying this correction, because you have seen a correction in the RSP, you fell about 8% from high to low, even from the low of the day today, down about 8%. Before I explain all that, I do want to share with you this clip from Tom Lee today, where Tom Lee essentially says, this is a good buying opportunity. Inflation is probably not on the resurgence unless there is a supply shock. We do have what could be a port strike shutdown here coming pretty soon, so that's definitely something to be watching for. But beyond a supply shock, we're probably not going to see inflation, and that the markets could actually run a lot in the first half of 2025. So take a listen to this.
What you wish for earlier, we were like, wow, there's nothing going on in the futures. We're down 20 points on the Dow, and we had just fractional losses. And here you go. It has turned into this, Tom Lee, significant declines. Now, especially after what happened last week on Friday. Tom Lee's here, Fundstrat Global Advisors, Chief Investment Officer, and a CNBC contributor. This is not this is a Grinch rally, or the Grinch sell-off. This is not a Santa Claus rally. It's not going as planned, Tom.
It's not. I think investors have been a bit nervous since December 18th, the FOMC rate decision, and worried that the Fed may not be as dovish as investors previously thought. But I think fundamentals have remained intact. So to us, I think this is a bit disappointing, but it's, I think, a bit of profit taking, some hesitancy around the Fed. But I think it doesn't really change that 2025 is shaping up to have a lot of tailwinds.
So this just delays some of the continuation in a secular bull market that you've been talking about?
That's right. I mean, I think one of the lessons of 2024 has been we've seen periods of market wobbling and weakness. We know investors get pretty quick to turn bearish when that happens, but it turns out that these have all proven to be buying opportunities. I don't think there's a lot of signal to me that December's been a weak month. It is obviously disappointing because it should be a seasonally strong period, but if we end down at even S&P 5,900 into year end, I don't think it just changes that in 2025. There's a lot to look forward to.
So what you thought might happen this year being put off. So what does that mean for next year? Let's say the first half of next year. What do you think we're in for? And with valuations and where multiples are right now, with all that in mind, do you think it could be a really positive first half of the year?
I do think that one of the things that we're watching most closely is what happens to CEO confidence early next year. We know they've been cautious for the last 2.5 years. It's really evident in looking at measures like the ISM manufacturing that's been below 50 since October 2022. And that's highly correlated with S&P earnings growth. I do think that that's going to finally recover to above 50, kind of signaling that we're back into an expansionary CEO mindset. It is purchasing managers. On top of that, we have an incoming administration that ultimately is going to be viewed by markets as pro-business, and I think that reignites animal spirits. And I think the Fed is going to prove to be dovish. Even if they're trying to figure out where neutral is, they're still supportive of markets. It's a good combination for I think, upside for equity. So, in the first half of next year, I think S&P can get close to 7,000, and that's a lot of upside from here.
7,000. You've made some prescient calls about inflation or about the markets based on inflation. Do you think recent worries that it's reheating are misplaced right now?
I do think inflation worries are misplaced. I know there's a lot of folks calling for a resurgence of inflation, and I know for whatever reason, January typically doesn't seem to be seasonally adjusted away, so we could see what looks like a surge in January CPI. But to me, the drivers of inflation are wages, and the Fed has said the labor market is not in a place that is inflationary. It's shelter, and we know shelter is really just catching up from the gap between where market prices are, which is not as inflationary, to how the statistical adjustments get CPI to where that needs to be. And we know auto insurance has really distorted CPI to the upside for the last few years, and that's cooling. So unless there is a supply shock coming, I don't know exactly why we would have a second wave of inflation. So to me, I think there's downside risk to inflation in 2025.
With that said, I generally agree with Tom Lee. I generally think now is a great time to be buying, although I don't know if we hit 7,000 on the SPY. My main concern there is big tech. Big tech has done well. Big tech is overpositioned. Big tech has lofty valuations that are really not supportive with their growth rates, especially something like an Apple, right? Whereas if you look at something like the RSP, as I talk about here often on this channel, you are seeing a much better setup here, right? Where you've already seen that kind of flush out, where you're seeing low valuations, where there is room for some repositioning back into markets. Okay. I like small caps. I like cyclicals. I like value. I like the boring stocks for next year. I think that is where the alpha is going to be. I think that is where the excess return will be, not just in the market cap weighted S&P. So really, to get the market cap weighted S&P to 7,000, you're going to have to see a lot further of a run in big tech. And I don't think that area looks good for next year. And I do think big tech is vulnerable for selling in January. Now, I think we will get a broader market rally in January, but I think big tech is vulnerable. Now, you have today, at the lowest point of the day today, you had 28% of stocks above their 50-day moving average. 72% of stocks were in an active downtrend. Whenever that happens during a bull market, you want to buy the crap out of markets. Now, maybe that's why things reversed a little bit into the end of the day. Things got a little bit better because you were so negative. I mean, how much more negative are you really able to get, right? You were at some of the, bear market lows of 2022 as far as the percent of stocks trading above their 50-day moving average, at some of the lowest levels you have seen in many years, right? That is a pretty damn good setup. Okay, anytime during a bull market when you're in the 30s, you're in the 20s of the percent of stocks trading above their 50-day moving average, you want to go out and you want to buy that market. Okay, as long as you're in a bull market, as long as inflation's not resurging, as long as the Fed is not doing a major pivot U-turn, about to start raising rates, or as long as the economy is not heading into a recession, which none of those things are happening, you want to be buying the market. Now, CNN's Fear and Greed Index today is now at 31, which is down from 34 as far as Friday's last close. And I believe the low of the day today on this was like 29. So I think you have come up a little bit. But you were in the bottom quartile of fear. Again, you want to buy this weakness when you are in a bull market. Last I checked, we were still in a bull market. Last I checked, really nothing changed. The last couple of days, the last couple of weeks, nothing changed. From a fundamental perspective, the situation looks exactly the same as it did, a couple of weeks ago. Okay. The only difference is people are a lot more fearful now, and there's been some depositioning for not much of an obvious reason, okay? Now, market momentum is fear, stock price strength, extreme fear, stock price breadth, extreme fear, put and call options greed, market volatility neutral, safe haven demand fear, and junk bond demand currently in fear. You want to buy the markets when people are this fearful, okay? And that's exactly what I did today. Now, perhaps I'll regret that if something does change, but I don't think that is going to be a move that will be regretted. Now, on the RSP today, something interesting also happened. You got this very low wick, right, where you kind of fell a lot, you recovered a lot. This is called a hammer candlestick. Whenever you get these hammer candlesticks, the last one happened here on September 11th, 2024. Look at that. Look at that low wick. You ended up falling a lot during the day. You recovered into the end of the day. And then what happened? You went on 3 good days back to back, up 0.63%, then up almost 1%, then up almost another 1%. Okay. Whenever you get a candle like that, it tends to mark the end of a sell-off or pretty close to the end of a sell-off. Usually it's a good buying opportunity. The last time before that you had one of these candles was here on May 2nd, 2024. You had this candle here where you fell into the end of the close. Well, you fell at the beginning of the trading day. You ended up closing at the high of the day, right? It looks like a hammer. Sometimes skinnier than others, sometimes a little bit fatter, but another hammer. And then what happened? You ended up rallying from there, right? You're getting another one of those. Here was another one, although it doesn't look as much like a hammer. Still, you rallied, okay? So whenever you get candles like this, it tends to be a good time to position into markets, not position away from markets. So we will see what happens over the coming days. I think today and tomorrow, you are again vulnerable for that repositioning, that tax loss harvesting related to 2024. And then maybe even Thursday and Friday, you could be in for some redeployment of capital as we enter the first couple of trading days of 2025. Overall, I think this is an opportunity that you want to be greedy of. You want to take advantage of it. When people are this fearful, it's not the time to run away from markets. unless something changed. Did something change? No, nothing changed. Okay. So you want to be buying into this market. Again, I'm not a financial advisor. I'm not a financial planner. That is my expectation. That is what I am doing with my money. I went out and bought almost $10,000 worth of stocks today. Very confident in that decision. But hey, I'm not a financial advisor. I'm not a financial planner. You do what is best for your situation. Let me know what you are doing down below in the comment section. Ladies and gentlemen, that is going to go ahead and do it for this video. That is everything you need to know in a nutshell without the stuff that you don't need to know. Have a great rest of your day, and I will see you in the next one.